All right, guys, thank you for having me here in our garage. Today I'm going to talk to you about real estate and why it is the ultimate wealth vehicle for both the present and the future. So a little bit about myself first. I'm a CPA. I'm also a licensed realtor. I used to live in the Bay Area as well. I worked at companies like Uber, Block, Dropbox. So I did the corporate thing, and then kind of realized that it's kind of slow. I didn't really like my corporate job. I felt limited into how much money I could make. Decided to leave San Francisco, move to Florida, and start buying up real estate. So, like most of you, I'm also an immigrant. I moved here from Russia in the late 90s. Real estate was new to me, right? Living in the Soviet Union, you can't actually own real estate, so I didn't know much about it. But I knew that I wanted to be wealthy. And when I began studying wealthy people in America, they all had one thing in common. They owned real estate. So they may have gotten rich through their company, they may have gotten rich through stocks, but at the end of the day, they put all their money into real estate. And why is that, right? Real estate is the only asset that can provide you 4 returns. So no matter who you are, if you buy real estate, you will get 4 types of returns. And maybe a potential 5th return that we'll talk about as well. So let's kick it off, right? So earlier, I believe Ron the 1031 guy said he bought the house for $100,000. So perfectly, this can fit very well into his example. So let's assume in 1990 he bought a house for $100,000, 20% down, 7% interest rate. And based on the 7% interest rate, your carrying cost will be about $650, but he bought a property manager who wants to be totally hands-off. His cash flow is very, very small. It's only $100 per month. But with that $100 per month, guess what? He's still getting a 6% return cash on cash, right? He put 20% down, 20K. He gets 1.2K as cash flow every single year, 6% return. Also, guess what? This cash flow is tax-free. You're not paying tax on this. Why? Because of expenses and depreciation. Depreciation is a giant non-cash expense, which makes your cash flow, in turn, tax-free. So we're getting 6% there. Next up is debt paid down, or forced equity, as they call it. So remember, this property, you're renting it out, right? You're not living in it. So who's paying the mortgage? Not you. It is your renter. So I know that in the mortgage world, they front load interest, but for this, I just kind of kept it simple. Assume you have an 80K loan over 30 years. Basically, your renter is paying about $2,700 of that loan for you, and that is forced equity. So assuming they pay 1/30th of your loan every single year, that alone is a 13% return on investment. Number 3, which is my favorite one, is tax benefits, right? Write-offs and depreciation. So as you're getting cash flow, boom, the cash flow is tax-free. You're expensing against it, you're doing depreciation against it. This is why people like to buy real estate, right? Cash flow is in your pocket, but on the IRS form, you're showing a loss. So you're not actually paying for any of it. Actually, you're not paying tax on any of it. And how much you're getting out of this really depends on what strategy you want to take, and we'll get back to this in a bit. And then the 4th one, which is the best one, which is appreciation. So wealth in real estate is really built through appreciation. The cash flow are the sprinkles, but the appreciation is really the biggest cake. And you want this cake to be as big as possible, because guess what? Appreciation is tax-free. So as Ron said, he bought a property for $100K, sold it for $1 million via 1031. Guess what? $900K of equity was tax-free. He rolled it over into a new property. Also, if you're worried about rate of return, if you look at the 50-year rate of return and you compare real estate and stocks, they are the same. They both get about 8.5%. Except the difference is that if you were to buy a stock and if you were to sell it, guess what? You pay tax. There is no way to avoid paying tax on appreciated stock after selling it. Not possible. However, with real estate, that's what it was designed for. Appreciate, 1031, tax-free. So, in this example, let's just assume conservative market. You buy somewhere in, say, Ohio or Indiana, very low appreciation. You get 5% increase over a year. Doesn't seem like much, but your annual return on this would be 25%, assuming that increases 5% year over year. And let's talk about the bonus fifth benefit. So, the first four that I mentioned can be done by anyone. So if you buy a long-term rental, right away you get those four benefits. However, you can get more creative and get an even fifth return to really, really maximize real estate and really squeeze all the juice and benefit out of it. So, real estate losses are able to offset active income. This is really important because most of you are probably pretty high income. So let's talk about the first strategy, short-term rental loophole. If you buy a property and you make it into a short-term rental and you run it as a short-term rental for a full 12 months, guess what? You can bonus depreciate the property and use that to offset your W-2 income. So including your RSUs, including your stocks, any form of income really. And then the second strategy is real estate professional status. So number one, anyone can do it. Number two, real estate professional status, or reps as they call it, a little bit more difficult. You can't be full-time worker, and real estate must be your number one profession. So if you have a spouse that doesn't work full-time, they can potentially qualify as a rep, and then you can use them to help offset more of your W-2 income. So, let's assume that you just get a pretty small bonus depreciation deduction. Let's assume you get a 10K bonus depreciation deduction. You're in the 24% bracket. That means you would have gotten $2,400 off of your your tax due. That 10K for you would be a full write-off. It would save you $2.4 thousand. So, when we combine all these returns for a real estate property in 1 year, you're getting above a 50% return. And that's just on one property. The more properties you have, obviously the more returns you'll have. And I think the biggest kind of thing with real estate too is that you don't really realize these benefits until way down the line, right? Real estate really is the ultimate get rich slow scheme. For example, like crypto had a really good year, right? It more than doubled in price. But guess what? You're paying 50% tax on the crypto. With real estate, yeah, you can buy real estate today, wait 20 or 30 years, probably have an even bigger return, and have it all be tax-free. It just takes a lot longer, and it's not nearly as sexy. However, it pretty much is guaranteed. So, how can the CPA dude help? What is it that we do? So, CPA dude, we really strive at ongoing tax planning and strategy. Unlike most CPA firms, we're there to build you a tax strategy so that you can really drive down your taxable income as low as possible. Taxes are complex, right? There is no such thing as a one-size-fits-all solution. So, as you guys come up and talk to me during the day, it's really hard for me to give you very, I would say, personal advice because I don't really know you as a person. That's why I always say, go call with me. We can talk things through. I'll get to know you, and then we can see if we can work together and what benefit I can bring you. Also, taxes are your biggest cost, right? A lot of you are in the 40+% bracket, so that means you need to take advantage of strategies to reduce your taxable income while at the same time building wealth. And real estate really is the ultimate vehicle for that. And then our company mission is really to act as the ultimate tax advisor and partner to our clients. If the issue is tax, you come to us for help, and we want to be with you for many, many decades to come. So, even though I was a CPA working in really big companies, doing really big things, I really didn't know much about real estate. I had no clue how it could affect my taxes and how I could use it to build wealth. However, as soon as I realized this, I decided it was time to quit the W-2 world, build this firm out, and really help other people in my shoes so that they can become educated about taxes as well as educated about real estate. So, if you want to chat with me, definitely happy to chat. Go on join.cpadude.com, pick a time, and you'll have a free 30-minute consultation with me. I'll learn more about you, you'll learn more about me, and we can see if we can work together.
Elder, thanks for coming in. I think you also flew from where?
Huh?
Did you fly, right?
We drove in from SoCal.
Yeah, see, a lot of folks here, like the guests, right, like they're not from here, but thanks for coming in and helping out the community here. But I think let's talk about the scenarios of the commercial properties. Like, reason I was keep telling you I bought this property, right? Reason I was telling is tax write-offs, how we can do it. I think let's talk about the scenario, right? Like, any new properties you buy, how can you do the tax write-offs? How does it help you out as an investment properties?
So it really depends, right? If you're buying a property and you both are W-2 workers, that property will be passive, unless it's a short-term rental. Then you can do a short-term rental loophole. If you have a lot of passive income, like let's say you invested in a company, or let's say you're in real estate for a long time, you can use the new building to offset your passive income. Or if one of your spouses doesn't work full-time, you can qualify them as a rep, bonus depreciate the new property you just bought, and you will reduce your family's combined earned income.
So basically, we can do a depreciate faster way instead of waiting for 27 years.
Exactly. Bonus depreciation is a very, very powerful tool. You're basically accelerating a good chunk of your depreciation in the current year versus spreading it out over 30 years.
Yeah. So basically, like instead of doing for 27 years, you do it in 3 years or 5 years. You find some rep who can do that depreciation faster.
So this is where cost-seg study comes in. If you want to bonus depreciate a property, you need to hire a cost-seg firm. The cost-seg firm will do a report. This is a licensed firm that does like an audit-proof report. Any property below a 15-year useful life will get bonus depreciated. It's usually about a third or a fourth of the property.
Yeah, and good thing about the CPA dude, really I liked about them is like they don't do a tax, go and just file for your taxes. They do a tax strategy, which is very important. I personally met with him once, one of my friends referred about him, and I personally met with him and really like the way he does. They meet once a quarter, or maybe needed more also, we can meet with them. Tell them what are the scenarios going in around your life, like maybe you're investing and you're planning to invest. Then he'll suggest you what are the ways, like, or you're getting in a bonus. What are the ways you can basically write off in the right way, which is very important.
That's exactly it. So we do have a former IRS auditor on staff, so we're aware of what will trigger audits, and we make sure that you are protected as well as that we are protected, right? We would never file anything we wouldn't feel comfortable signing, because we would also lose our license as well.
Yeah, because recently I was reading one article where Apple employees, 6 employees were like, did the wrong way of writing off submitting it to a non-profit organization, okay, and they were getting back the kickbacks.
Yes.
Right?
Yep.
So that is why like tax might be lot of people think of it as simply write-off. No. Do it right way so that it will, if you're paying little bit extra taxes also, in the future gives you peace.
That's exactly right. So a lot of firms are doing very aggressive tax strategies that are very nearsighted. We avoid that altogether. Our goal is to make sure you guys keep on building wealth. Building wealth means staying out of jail and not paying fines. So we may be somewhat conservative, but I think that for the long run, you will be most safe as well as have the most wealth as well.
So I think you said one thing, the jail time. The wrong taxes, or if you're filing it, does you guys get it, means they are liable for the jail time?
Are we liable for jail time? We are not, but we would lose our license.
Yeah. So everybody like plan strategically, talk to him, talk to the team, set up an appointment with them. It's a free consultation, which is really use for it and see how they can help you to save the taxes for you guys. Thank you, Elder.
Thank you guys.